Good morning from Dubai. In this series, we're going to talk about the decentralization of finance, or DeFi, the fundamentals of it. And one of the key aspects of this is the liquidity paradox, and we're going to talk about that in a little more detail. This series actually seeks to demystify some of the questions that we have about blockchain-based finance, or crypto, or stablecoins, or the other aspects. So looking forward to take you on this journey in this part as well as the following ones. So after the 2008 financial crisis, the trust in the centralized form of banking, of financial intermediaries or gatekeepers, eroded tremendously. And there was a movement from technologists to create an alternate system, a system that enabled anybody like you and me with access to the internet to be able to transact with each other. And in order to be able to make these transactions irrefutable, we would use simple technology rather than all the complex policies and procedures that the banking system brings to us. Now, as you go around Dubai or the UAE, you'll find that there are a number of car parks which have solar panels instead of roofs, and these actually generate a lot of power that feed back into the buildings that they're attached to or even into the grid. Now, this is a form of decentralization, and the decentralization of finance is actually quite similar in many ways. The idea that you can actually translate energy or work or ownership into value and then feed that back into a system that enables the movement of money between people or between institutions is basically the problem that DeFi is trying to solve. Can we do all of the financial services transactions that we currently do without the need for a centralized system to either pump in money or to take out money or to arbitrate the transactions between people or entities which are doing business or just plainly transacting? Central to the idea of Web 3.0 money or blockchain money, like Bitcoin or any other kind of crypto or stablecoins or any other kind of digital currency, is the idea that these are assets, and assets can best be exchanged in an exchange. To draw a parallel, let's take the New York Stock Exchange. There are thousands of stocks that are traded on the New York Stock Exchange and millions of investors that go in and out of the exchange with their money on any given single day. Now, this speed of exchange is enabled because of the sheer volume of the number of people who are actually trading, or the number of entities that are trading on the New York Stock Exchange. So what happens as a result of that high volume and the high availability of money in the New York Stock Exchange is that prices are stable. Usually the exchange itself is quite stable. The prices themselves are the best because there is so much of movement going on of buying and selling. And the third is that the speed at which the orders are executed is extremely fast because it's required in order to be able to enable all these transactions. Now, the same idea holds true also for digital currencies. Any exchange that they're traded in requires there to be a high level of volume, a high level of transparency and pricing as a result of that, and the actual order taking needs to be done very, very quickly so that the orders can be quickly closed. The smaller the exchange, the more the trouble is there in being able to exchange, primarily because you're not able to get the right price at the right time. Sometimes these orders can take a long time to execute, and as a result of which, these prices in these exchanges are typically not stable. So it is very, very essential in order for an exchange to function well that there is a reasonable amount of volume that enables stability of pricing, the right price, as well as the speed of execution of the order. I could have changed the name of the slide to actually say liquidity powers mobile money. And I'm going to go back to a little bit in history about 2009, 2010 time when mobile money was taking off in many parts of Africa and Asia. And during that time, it was essential that liquidity was available in order to be able to move money out of closed-loop mobile wallets into the open world of fiat. And this was a problem that needed to get solved very, very quickly because people were putting their money into mobile wallets for safety, primarily, or to do remittances. But it was very difficult initially to get the money out. And so this problem was solved by the creation of a number of mobile money agents across the countries in which these mobile money operations existed. Now, these mobile money operators or these mobile money kiosks basically are mini exchanges. And what they do is they exchange the mobile money that the user has versus the fiat money that they hold. And the more liquidity or the more fiat money that they have, the easier it is for the user to be able to get their money back from the mobile money system. Exactly the same operating principle also exists in the world of DeFi. There is no ability to actually use DeFi for any purpose whatsoever unless there is a very strong ability to have this money exchanged, whether it is for trading, it is for lending, or for use for investment. There is a high need for these exchanges to exist. And it becomes even more imperative because in the DeFi world, there is no central bank and there is no central authority that is actually creating and releasing this liquidity through channels like banks. And so it's very, very important to understand that in the DeFi world, like it is in the mobile money world, liquidity replaces the trust in gatekeepers. So in the case of mobile money, liquidity replaced the trust in the banking system because it enabled people to actually go and get financial services from the corner shop. And in the same way, a parallel is being created in the DeFi world where liquidity is being created primarily through the availability and presence of multiple easily accessible exchanges. And now it's time to introduce the concept, a very central concept in the DeFi world, which is the liquidity pool. And in a liquidity pool, it's basically a smart contract that replaces that mobile money kiosk or mobile money operator that we talked about in the previous slide with a smart contract. So you've actually now got technology doing pretty much the same work. In a liquidity pool, what happens is that a liquidity provider, typically called an LP, deposits typically two cryptocurrencies or two DeFis or two forms of assets of equal value into the pool. Now, this enables the pool to have a fair amount of value, which is, as I said in a couple of slides earlier, the more the value that's available in the exchange, the easier it is to actually do transactions, the easier it is to find the right price, the easier it is to actually execute the transaction in a timely manner. Now, what happens is, what's the value for the LPs? So for the LPs, for the liquidity providers, the value is that the use of their money actually generates income for them. So they get fees for the use of their money, and therefore there is an incentive for the liquidity providers to put their crypto assets, to put their DeFi assets into a liquidity pool. And typically, the LPs get the fees, and paradoxically, the pools set the price. So now let's for a moment go back to our world of stock exchanges and go back to our world of mobile money agents, right? The things that we kind of are far more familiar with. And in that world, it is very, very important that there's communication between the various operators in the system. So typically, if you take the US stock market, it's not just the NYSE that actually exchanges stocks and assets, but there are multiple exchanges across the US. And typically what you'll find is that the price discovery or the pricing across each one of these exchanges is not very different from the other. It's a very, very small margin of difference, not even enough to have an arbitration. And this is because of the ease of the transmission of information between these various entities so that there is no arbitration on price. In a similar manner, in the mobile money operator world or the agent world, the proximity of the agents to each other actually ensures that no one agent actually is in a position to be able to command a higher or lower price versus what the typical exchange rate would be. And if you take this example now back to the mobile, to the DeFi world, remember we said that the DeFi world works on smart contracts. And for these smart contracts to work, these smart contracts need to actually talk to the real world. And they talk to the real world through programs called oracles, which fetch real world data and plug them into the smart contracts. The second thing is that there are aggregation mechanisms or technology aggregators that bring in a lot of information, just like the stock exchanges, across multiple digital exchanges, thousands of digital exchanges. They can get aggregated and the prices can be compared across these multiple exchanges. The third, of course, is the ability to actually move assets, not just from one exchange to another, but also from one blockchain to another. And this is done through something called cross-chain routing, which enables the movement of money through exchanges, and across chains. And I guess one of the things that I'd like you to do is to prepare to start learning about things like Uniswap. It's a term that will be important as we go and keep discovering more and more about this fantastic world of DeFi. So what exactly is the liquidity paradox? The liquidity paradox is that the choice is high, but deep liquidity is rare. Inbuilt into the entire mechanism of decentralized finance is the ability to be actually able to create smart contracts and exchange value literally in an instant, right? You can instantaneously set up an exchange and you can start receiving and giving out value. But in this very design mechanism, or in this very mechanism, there is a design problem. The design problem is that you create a multiplicity of exchanges. There are many, many, many thousands of exchanges out there. Thousands of pools that are being created. They're so easy to create. And therefore, the liquidity gets fragmented across all these exchanges. The other problem that happens is that because there are so many different blockchain protocols, this issue becomes even more fragmented. Today, the problem that's in front of us is not that DeFi isn't great, it's fantastic. The problem is, how do we balance out the centralization of, it's the wrong word, centralization is the wrong word. How do we balance the harmonization of DeFi versus the very fact that DeFi is so fragmented? And I think this is one of the big problems that is being solved right now. Solutions exist right now, they're not widely adopted, but solutions exist. And I'm very, very hopeful that in the near future, this will get sorted out quite well. Right throughout history, humankind has suffered from the problem of a few people getting an enormous amount of power. It's been a problem right throughout, whether it's political power or money power, whatever else it is. And finally, we are coming to a stage when technology can actually help us probably mitigate that issue. We thought the internet would be able to do that for us, but as history has proven, today the internet is controlled, or the technology is controlled, or the advances of the technology are controlled by a few people who are making a huge amount of money off the internet. Now, the question is that will we be able to actually achieve independence or a more granular level of control for human beings with DeFi? And that's a question which we don't have an answer for right now. But let's try and think of all the mechanisms that are there. Now, you might have heard about the term whale. And typically the whale applies to people who have very quickly gotten into the Bitcoin game, amassed a huge amount of cryptocurrencies or any other cryptocurrencies that's been created, and they amass a huge amount of cryptocurrencies. How do we prevent these whales or big VC funds from taking control of the very independent pools, or the very pools that we are trying to create for our own financial independence? And so some of the mechanisms that we've thought about, or the world is thinking about, is actually capping the voting power of participants in pools, not just on the basis of the total amount of funds available, but just a cap. That's it. That's the total number of votes that are available to any entity participating, regardless of the funds that they actually allocate. The second thing is to actually prevent tactical kind of occurrences by making sure that there is a certain length of time that's linked to your ability to vote. Also, design the organizations or the DAOs that run these pools such that the early entrants don't get phenomenal power. And of course, another mechanism is to give sort of an unfair advantage to smaller wallets to be able to participate in this ecosystem. So these are some of the mechanisms that are out there in order to be able to mitigate what we call whale risk. So there you have it. I began the fundamentals of DeFi with the liquidity paradox, because I think this is one of the central problems of the entire world of DeFi. On the one hand, DeFi enables us to be able to create these pools of liquidity, exchanges that enable us to create value and exchange value quite easily. Now, at the one end, of course, is the ability to create thousands and thousands of such pools because it gives us a lot of independence. But at the same time, we have a counter problem, which is the need to be able to harmonize all these pools so that they talk to each other and are able to exchange value across these pools quite easily. The interoperability of these pools, if I may say so. And today we're at a stage where technology is actually enabling us to do this, because that's the way we're going to be able to get value for all the hard work that we do and all the money that we earn, or all the value that we earn. The alternative is not a great one. The alternative is the one that we've lived with, where there is a centralized control of money, and this centralized control of money determines what the value of money is to us. This centralized control determines what the interest rates are. This centralized control of money tells us how much of money is actually available in the system, and so on and so forth. And therefore, to a large extent, that value, the economy, is manipulated by this centralized control. I'm not saying it's a bad thing. I'm just saying that these are two different approaches to be able to manage money. With that, I'm ending the first part of the fundamentals of DeFi, what I call the liquidity paradox. And of course, there are going to be more of this, so please tune in to hear more about what DeFi has to bring to us.